أعوذ بالله الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. So this will be our second lesson in our course. Yesterday we started talking about business ethics, an introduction to business ethics. We defined what business ethic is, and we saw the difference between ethics, law, the difference between ethics and law. Then we also talked about the importance of business ethics and the objectives of business ethics. Then we also talked about the principles of business ethics. Then the last part of our lesson yesterday, we talked about the theories that helps us to understand ethics, Then we also talked about ethical decision making and ethical dilemmas. Now, in our lesson today, we shall be talking about corporate governance. And corporate governance is somehow related to what? Can you please mute your words? There are some students that are disturbing us. Mute, please, your mic, please. So now, these are going to be our lesson's objectives today. So number one, by the end of this lesson, you should be able to define corporate governance and explain its objective, distinguish between shareholder and stakeholder governance models, identify principles of good corporate governance, explain the roles and responsibilities of boards and management, then understand board composition, independence, and CEO duality, then describe key board committees, then explain shareholder rights and stakeholder engagements, analyze stakeholder conflicts and governance mechanism, then lastly, understand corporate accountability and transparency. So this is in brief what we shall be discussing in our lesson today. Okay, now number one is the definition of corporate governance. What is corporate governance? In Arabic, corporate governance is known as al-hawkama. That is the word in Arabic, al-hawkama. Now, what is the definition of corporate governance? So, corporate governance, or al-hawkama, refers to the system of rules, practices, processes, and relationships by which a corporation, what is the meaning of corporation? Corporation means an organization, or it can also mean a company. So, by which a company organization is directed and controlled. These key two words are very important. How corporations are directed and how they are controlled. It defines how power, as-sulta, and responsibility, mas'uliyah, are distributed among shareholders, board of directors, management, and other stakeholders. Now, in the key definition, they are telling us corporate governance involves a set of relationship, majmu'at al-alakat, between a company's management, its board, its shareholders, and other stakeholders, providing the structure through which objectives are set and performance is monitored. Now, that is what corporate governance is all about. But before we even go to corporate governance, we need to know the structure of any company, the structure of any organization. Now, if you look at this structure here, so for example, let us take an example of the Habshil Bank. So this is the structure of the Habshil Bank. Up here, we normally have Al-Musahimin. Al-Musahimin these are the shareholders. What is the meaning of shareholders? Shareholders, these are the investors. Al-Mustathmirin, these are the people who have injected their money in Dahabshil. So they have their shares inside Dahabshil Bank. They have shares. So they are the ones who basically, they are up in the structure. Then down shareholders, we have board of directors. Board of directors is what? Majlis al-Idara. So this board of directors, it is appointed. It is appointed by the shareholders. So in some companies, they are appointed after every year. In some companies, they are appointed after 2 years. So it depends with the nature of the country, the nature of the company, and it also depends with the company laws in the country. So the shareholders, they do what? They elect in the annual general meeting, they elect the board of directors. Now, this board of directors, they elect a chairperson. Mathalan, if they are 10, they decide that one of them is going to be the chairperson. Now, the board of director, that is the Al-Majlis Al-Idara, it is the one that appoints the Idara. It is the one that appoints the CEO, the chief financial officer, chief operating officer, the what? The head of human resource management, the head of marketing, ila ghayri dhalik. So it is the board, it is the what? It is the board of directors that appoints the CEO, the COF, and the chief financial officer, and any other person who is in management. Now, when we are talking about al-hawkama or corporate governance, here majmu'atul qawaid principles were al-mabadi that helps us to direct and control how the business is being managed. Because remember, at the end of the day, the shareholders, they have invested their money in Dahabshil. So what do they want? The shareholders, they only want one thing. They want al-arbah. They want al-arbah. They want profits. So how can this profit be achieved? So that is how corporate governance is going to help. So with corporate governance, you are going to find that you are going to have committees, the audit committee, the remuneration committee, a lot of committee that is going to help. Because the shareholders, they don't want to lose their money. So that is why they appoint the board of directors, who should be very qualified. We shall also talk about the composition of the board, which is very important. Now, this board of directors, they are the CCTV of the organization. CCTV, meaning they normally check to see if the management is acting for the interest of the shareholders. So that the board of directors, they are the link, al-wasita, between shareholders and the management. So if the shareholders, they want anything, they communicate through the management. And if the management wants anything, capital to be injected in the business, then they communicate, they communicate through the board of directors. Now, this is the same thing. This is the same idea, basically, they're trying to say. So we normally have the shareholders. These shareholders, they are the musahimin. They are the people who have invested in the business, the Habshil. So this shareholder, in their meeting, they do what? They appoint the board of directors. Now, the board of directors, to ensure that the business is being managed effectively, they normally form 3 committees. So if you go to the Habshil, you will find there is the audit committee. You'll also find there is the remuneration committee. You'll also find there is sustainability, the steering committee. And you can find many other committees. It depends with the nature of the company and the organization. So these committees, they help the board to ensure that the management team, they are acting for the interest, the interest of the shareholders. So most of the time, in some organization, you find that the shareholders, most of the time, they are not happy. They are not happy because the business is not doing well. Why? Because the management team is corrupted. Hunak al fasad. They are not acting for the interests of the shareholders. They increase their salary, they waste the money of the organization. They think about their stomach. إلى غير ذلك. So this structure, so this is what corporate governance is always ensures. If you go to a hospital, the corporate governance is there. You'll find there is this hierarchy. You go to school, you go to university. So the idea of corporate governance, it is in any kind of business or any kind of organization. You'll always find corporate governance. Now, what are the objectives of corporate governance? Why do we need the structure? Why do we need corporate governance in our organizations or in our companies? Is it important? Why should we have all these committees? Why? So number one is to ensuring accountability of management to shareholders. So accountability of management to shareholders, al-muhasaba. If they are not doing their work, the board of directors is going to inform the shareholders, and in turn, the board of directors is going to change the management team. So accountability. Thanian, protecting shareholder and stakeholder interests. Remember, these shareholders here, they have invested their money. So they want profit. They want increment. They want value addition. Number three, enhancing transparency and disclosure. So these three committees are always formed to ensure that there is shafafia and disclosure. That is, the financial statement should be disclosed to the board of directors, and the board of directors will disclose it to the shareholders. Then preventing corporate fraud and abuse of power. Corporate fraud means al-fasad and embezzlement of funds and abuse of power. It ensures that this management, they don't misuse their power. If they misuse their power, the board is going to change them. The board is going to check them. So it ensures that the manager, the CEO, does not abuse his power. Then supporting long-term value creation and sustainability. If you want the business to run for many years, the long-term value creation. If you want the business to earn profits, increase its sales, you need a very good corporate governance. Strengthening investor confidence and market integrity. So investors, once they have confidence, and when you're talking about the investors, these are the shareholders. And when you're talking of investment, maybe there are some other people who want to invest in the Habshil. So if their corporate governance is very good, they will come to invest with the Habshil. But if the corporate governance in the Habshil is not good, they'll not put their money there. Ensures corporate actions obey law and reflect ethical standards. So the corporate governance ensures that the organization and the people who are working in it, they obey the law of the country. And also it reflects ethical standards. And yesterday we talked about ethical standards. Now, this is very important. Governance model and approaches. So when it comes to al-hawkama, هناك مدارس كثيرة. We have two schools of thought. هناك المدرسة, we have two, as we shall see. But what is governance model? So the governance model refers to the framework that define how corporations are directed, controlled, and held accountable. So this model, they explain whose interests, underline the word interest, al-maslaha, whose interest the company prioritizes, who has decision-making power, and how corporate objectives are achieved. So when you're talking about the model, it is all about ما هي الأولويات المنظمة أو الشركة. Who comes first? Who? So to answer this question, لإجابة عن هذه الأسئلة man, who comes first, there are two models. So number one, we have the shareholder model. So the shareholder model, it is Anglo-American. Anglo-American means that many organizations in the United States, in the United Kingdom, Canada, and Australia, they use this model. Many of their companies and organizations, they use this model. So it is called the shareholder model. So what is the reasoning behind this model? So the shareholder model is a governance approach in which a company's primary objective, underline this, is to maximize shareholder wealth. Full stop. That is why it is called shareholder. So man fil muqaddima, the shareholder. So we are, all of us as an organization, we are working to ensure that the shareholder is happy, to ensure that the shareholder gets value from their investment. Full stop. So, and management is accountable mainly to the owners of the company. So the management, it is responsible, to the what? To the shareholders directly. Now, shareholders are considered the principal stakeholders because they provide capital. Remember, they are up there. They are the ones who are giving money and bear the greatest financial risk. So these are the people, if the Habshil dies, who is going to lose the money? The shareholder is going to lose the money. So we need to act for their interest. So the board of directors represents shareholders and monitors management to ensure what? Profit maximization. Ta'azim al-arbah. So success is largely measured through financial performance, stock price, dividends, and returns on investment. Other stakeholders, al-baqun or al-baqin, the employees, the customer, the society, are considered important, but secondary to shareholder interest. They come second. So the shareholders come first, then the shareholders, they are the primary focus. The others, they are what? They are secondary. So this is the idea behind the shareholder model. So if you come to the shareholder models, this is the Anglo-American. So the board of directors, so the shareholders, they elect the board of directors, and the board of directors, they elect the managers, and they ensure that the business is being managed in an effective and efficient way. Why? So at the end of the day, the shareholders, the green one, we are working only we have to ensure that the shareholders are happy first. Then the others, they come later. So that is the idea behind this. Now, number two is the stakeholder. Number two is the stakeholder model. So the stakeholder model, there are some countries in Europe, they normally use it. So there are some countries in Europe, for example, Japan, France, Germany, and other continental European country, especially, for example, if you go to the Netherlands, if you go to Sweden, Norway, so they use this model. So this model is the stakeholder. Remember, the first one is shareholder model. This one is stakeholder. So the stakeholder model is a governance approach in which a company is responsible not only to shareholders, but also to a broader group of stakeholders. So basically what they're telling us here, you have many stakeholders. So the corporation, this is the company in the middle. So we have the shareholders, yes, but we also have the other stakeholders. So the other stakeholders are the managers, employees, suppliers, bankers, competitors, government, ila ghairi dhalik. So the objective of this model is that we need to satisfy and we need to do what? We need to work for, and we need to satisfy the interests of all the stakeholders. We need to make all the stakeholders happy. So we don't consider only the shareholders as the important group, but we also consider all the other groups as being important. So I don't know in Somali which model is used in Somali, but for example, if you go to Kenya, you will find they use the Anglo-American model. Because at the end of the day, Kenya was colonized by British, so most of its practices, they normally borrow a leaf from UK. So in Kenya, most of the companies, they use the shareholder model, and they don't use the word, and they don't use the stakeholder model. The stakeholder model is used in Rwanda, I think, and Tanzania also. Many companies in Tanzania, they use the stakeholder model. Okay, the next part of our lesson, principle of good corporate governance. What is the meaning of this? ما هي المبادئ الحوكمة? Number one is what? الشفافية, transparency. So what is the meaning of transparency? It refers to the open, accurate, and timely disclosure of all material information regarding a company's activities, financial performance, and decision-making process. So transparency, shafafia, means we should be open. Al-abwab yakun maftu. If anybody wants information, they can easily go to the manager and ask. Number two, dikkatul ma'lumat. The information should be accurate. Then number three, timely. This information should be given at the right time when it is required. Number two is accountability. Al-muhasaba. So accountability is the obligation of the board of directors and management to answer for their decisions, actions, and performance. So accountability basically means in an organization, kullu wahid mas'ul. Everybody has a responsibility. And with responsibility comes al-muhasaba. So you have the responsibility to make decisions. You have the responsibility to take some actions. But fil muqabil, so there is accountability. So they'll ask you, why did you make this or take this decision? Why did you decide to buy this asset? So the management and the board of directors, they are answerable to the what? They are answerable to the board of directors. Responsibility, this is what we were saying, mas'uliyah. Responsibility means that the company act is lawful, ethical, and socially responsible manner, considering the impact of its decision. Responsibility basically means our decisions, they have to be ethical. And remember yesterday when we were talking about ethical means what? Ethical means it has to be right, it has to be what? It has to be also legally, accepted, ila ghairi dhalik. Then fairness, equity. Fairness refers to the equitable treatment of all stakeholders, okay, regardless of what? Of all stakeholders. Fairness refers to the equitable treatment of all shareholders and stakeholders, including minority and foreign shareholders. So, for example, you have companies in Somali. And in these companies in Somali, we have foreigners who have invested in companies in what? Who have invested in these companies in Somali. So they have to be treated equally. Just because I'm a Kenyan and I have invested in a company does not mean that I should not be given my right. No, that should not be the case. I have to be considered as part and parcel of the what? Of the main shareholder or stakeholder in a company. Now, independence, al-istiqlaliyah. Independence means that the board and its committee are able to make objective and unbiased decisions without undue influence. So this is very important. So when we are appointing the board, the shareholders, they normally appoint the board. The board has to be independent, because when they are independent, they can make objective and not subjective decisions. They should not be controlled. They should not be manipulated. The same thing with the management of the company. The board of directors, they have to give the management of the Habshil Bank the independence to make decisions, the independence to act. They should not manipulate them. Because if they are not independent, it basically means they'll not be working for the interests of the shareholders. Then disclosure. Disclosure is the process of providing relevant and material information to stakeholders in a clear and understandable manner. This is very important. When, as an organization, you meet with all the stakeholders, you need to provide them with clear information. The information needs to be very clear and they can easily understand it. Sometimes the members of management, they will give complex information, especially when they are presenting the financial statement. There are some stakeholders or shareholders, they did not go to school. So sometimes they don't understand these figures and numbers. So it is required of you to do what? To simplify it, tabsit al-ma'lumat, so that all the shareholders can know, can understand exactly what is happening. So we should avoid complexity of information as much as possible. Rule of law. Rule of law means that the company operates in strict compliance with legal and regulatory framework. Rule of law means, for example, if the Habshil, they're working in Somali, it basically means they need to follow the constitution of Somali. They need to follow rules and regulation in Somali. You cannot break the rule. You cannot break the law. And this means that they have to pay taxes. If you don't pay taxes, the Habshil does not pay the government the tax, then they will not be acting in an ethical way. And they'll also be doing, they'll not be doing what, it will not be legal for them to do that. And they can be arrested and charged in a court of law. Payment of their employees in time is also a requirement. The constitution, the labor law of each and every country requires you to pay your employees satisfactory amount of money. The law of the country requires you, for example, not to pollute the environment. Stakeholder recognition. Stakeholder recognition acknowledges the legitimate rights and interests of all stakeholders affected by the company's operation. Stakeholder recognition basically means that as a company, we have to be cognizant of all the people who are affected, either directly or indirectly by our decisions. We need to recognize them. We need to acknowledge them. That is the only way we are going to enhance the reputation of our company. Now, boards of directors and management. This is very important. Remember when you were talking about our structure, we said that we have the shareholders, then the shareholders, we have the board of directors, Majlis al-Idara, then we have al-Idara. So we want to see what is their role in any company. So number one, the roles and responsibility of boards. Boards means Majlis al-Idara. So number one, what is their role? Setting strategic direction. So in the Habshil Bank, Mathalan, you'll find that they have a strategic plan where they want to see themselves 5 years, 10 years from now. Who sets that strategic direction? It is the board. Number two, appointing, evaluating, and compensating senior management. Who appoints the CEO of any company? It is the board. Who appoints the chief financial officer? It is the board. So they appoint, they evaluate, and they compensate. The board of management decides how much the CEO is going to get as salary. They can increase or decrease it. Overseeing risk management and internal control. So the boards, they always ensure that idaratul makhatir is okay, and the internal control, both the external auditing and the internal auditing, is okay. They ensure ethical conduct and compliance through policies. They protect the rights of shareholders and stakeholders. Then boards act as fiduciaries. What is the meaning of this? That is owing duty of care, loyalty, and good faith to the shareholders. So for each and every decision they make, they need to take care of the shareholders. They need to be loyal to the shareholders. They need to act on good faith for the development and the growth of the company. Now, the board composition and independence. Now, when we're talking about board composition, ماذا نعني؟ تكوين مجلس الإدارة. So, how should the board look like? Some companies, they don't care, la mubala. They just appoint people in the board, people who did not go to school, people who don't have experience, they are tribesmen, they are relatives, ila ghairi dhalik. After some times, the company goes down. So you have to be very careful with takwin al-majlis al-idara. So board composition and also the independence refer to the structure of the board of directors in terms of size. So what is the best size of a board? Should it be a big board, small, or medium? What is the best practice? It depends. The diversity. What is the meaning of diversity? When you are talking about the diversity, how many men and women should be in the board? Should all of them be from Somali? Or maybe some of them can be from Kenya, Tanzania. So can you have foreign? So the diversity of your board, is it the skills, the board members, what skills do they have? Experience, board members, what kind of experience should they have? And the presence of independent directors. And we also have to ensure in any board, we normally have independent directors and non-independent directors. So we need to have a balance between these because it will ensure objective oversight and effective decision making. Now, what are the important principles of board composition? Number one, balance board structure. Balance. So a balanced board consists of an appropriate mix of, we have executive directors, non-executive directors, independent directors. So you need to have a mushakal. What is the importance of this mushakal? It prevents dominance by management. It encourages diverse viewpoints, enhances strategic decision. So if there is mushakal, there is going to be diverse viewpoints. This one has this idea, another one have a good idea, another. So you are going to have rich ideas. Number two, independence of directors. Board independence means that a sufficient number of directors are free from management influence or conflict of interest. It means that the board of members, the board of directors, they should not have direct influence or conflict of interest with the management of the organization. Because sometimes you have the board and the management. The management tells the board, hey, can you do this, decide this, take this course of action. That is not independence. Appropriate board size. So board size should be large enough to provide expertise, but small enough to function efficiently. So it should be balanced. It should not be large. It should not be small. It should be in between, you know. Then the diversity of skills and experience. Board diversity refers to the inclusion of directors with varied professional background. So if you, a good board should have somebody with experience in marketing, another one have an experience in law, another one has an experience in human resource management, another one has an experience, for example, in IT, ICT. So the board should have people who are competent enough, you know, skills, gender, there should be some gender balance. So the board should not just be dominated by the male, you know. Then separation of roles, chairperson and CEO. So this principle recommends separating the roles of board chairperson and chief executive officer. So this is what is known as CEO duality. In some organization, the chairman of the board is also the CEO. That is, it is known as CEO duality. You are the chairman of the board and you are also the CEO. In some organization, they separate it. The chairman of the board cannot be the CEO of the company. And that is the best practice, because it will ensure that there is no conflict of interest, because you cannot be the chairman of the board, because this board is the one that checks the management. Now you are in management and you are also in board. How can that happen? Who is going to check the management? So the best practice is to separate them. Now, competence and integrity of directors. Directors should possess relevant expertise, ethical standard, and integrity. The board should be people who don't have scandals, people who are not corrupted, people who have a very good CV and reputation in the society. They should be the ones in the boards of organization. Now, we also need to have the independent board committees. So Janiban, we normally have key committees. We have the audit committee, the nomination committee, the remuneration committee, should be composed mainly of independent directors. These committees should have directors who are independent. What is the meaning of independent? Independent means that these are directors who have not invested in the company, who they don't have any interest in the company. They did not put their capital in the company. So these are the ones who are known as the independent directors. So we'll continue the lesson after the break. I will send another link because we only have a few seconds remaining. So I will send another link. But khulasatul qawl, effective board composition and independence ensure strong oversight, al-murakaba al-qawi, accountability, that is al-muhasaba, then transparency, this is the shafafia, and strategic guidance. When you're talking about strategic guidance, we are talking about the vision. Ar-ru'ya should be very clear, forming the backbone of good corporate governance. Now, after the break, we're going to start with this last part.